Yeah. Okay. Thanks everyone for attending. It's already 7:02. So we'll try and start right now. I think we just give one more minute for some people who's signing in. Thanks everyone for attending. We're all doing this from home. All the analysts are working from home, so we're actually just controlling it from home. So apologies if we might have any technical issues. So give us one more minute, then we'll start. Yeah. Thanks everyone. Okay. Yeah. Okay. We're going to start right now. Okay, so anyway, the reason we have this cover or this title is not to make a pun or joke on the situation right now, which is very serious, but it's just a reminder that now if you want to bet on the equity market, it's really us versus the virus, and you basically have to bet on us. Anyway, this image was basically 50 years ago we were already worrying about fighting this virus. Okay, but anyway, I'll just move on. Okay, in terms of our agenda, we'll just go through very quickly first quarter performance of the stocks and equity. Very quickly on economic conditions, I think right now no point talking about the economy too much. We know things are bad, so there's not really much value add to discuss. We'll just have one slide on it. We give you 5 reasons why we think it's a good time to enter the market. The timing may not we still think there could be some downside, but in terms of the prices right now, they're obviously really attractive, and why we think that the reasons why you should actually go into the equity market. Just that we'll explain later why we think there still could be a bit of downside because the market is just so volatile right now. We'll also provide a technical update by Wei Ren. He does it. He'll just share some thoughts on the STI, and we'll do our usual sector views and then our stock picks. Okay, in terms of the year-to-date performance, this is as of 26 March. Again, nothing much here. Just want to tell you everything is in the red. For Singapore, we outperformed ASEAN, but I think no consolation here. I mean, we lost less than the rest. Okay, actually, we even underperformed the MSCI Asia ex-Japan here. Okay, in terms of the performance of the equity stocks, transport has been the worst hit, as we know. It's down almost 40%. The worst performing STI component stock is ComfortDelGro, and the others will be SETS and SIA expected. Again, nothing was bad. Even consumer sector was similarly bad. Genting we can understand. Even Jardine here is more Indonesian auto, so that is understandable. Indonesia is also hit, and also the banks, of course, were not spared. Banks are also down. Even the REITs also have suffered. All these are the 3 worst performing REITs. And then property was not spared. Okay, the only one gainer this year was been the SGX. So that's the only champion of the STI this year to date. That means up to the 30th of March has been SGX. Okay, but anyway, enough of the rate. We'll just have we'll just run through the current economic conditions. Actually, Singapore up to February was doing pretty well. Actually, as you can see from here, our exports on the left chart was actually climbing. We were actually recovering after the dismal, because of the trade war. You can see that the exports for Singapore really collapsed. You can see from the red line, it's actually worse than the 2008 for electronics, but we're starting to recover very strongly, even up to February. And if you look at PSA, just to get a sense of what's going on world trade, we were actually improving. Of course, right now everything is off. Everything's off the table right now because of the economic situation. And financially, our reserves, although it seasonally we always have this drop, but it's also still at a very healthy state. So Singapore was reasonably performing well. The one place that obviously got hit the most is tourism. You don't have to rub your eyes. Actually, this is true. This is really 90% drop. Okay, so the arrivals from China dropped 90% because it's almost zero. 90 is zero. Then likewise, it drove down the Singapore visitor arrivals down to a decline of about 50, this on the left hand side, so about 60-70%, 50+%. Anyway, Natalie later will discuss a bit on the hospitality sector. This is just the economic numbers. Okay, I need 5 reasons to buy. Obviously, everything's on sale now. Okay, anyway, firstly, it can be contained. I mean, we are not virologists here, but you can see that just on the data, you can see that China did manage to contain the number of cases. Likewise, you can also see that it also has Korea also managed to be contained. So at least likewise, we know that this virus at least can be contained. So that's the positive part, looking at the data from WHO. Again, this is nothing much, and this is just a reminder why this thing spread so much from 1% to 3 to 9 to 21, 28. So what you want to do is you really just want to cut out so you can cut out the numbers. Okay, anyway, but to do so is a huge economic cost. As you can see, China managed to contain by a huge economic cost. You can see all the data here. This is the PMI, manufacturing activity just collapsed in China. Likewise, even electricity consumption collapsed, and retail spending, online retail spending, which is, so China is always supposed to be the golden goose in consumer, but even online also collapsed, and even residential space. So you can contain, but there is a cost. There's a huge economic cost. So the first reason why we're positive is that we have seen this COVID outbreak being contained in countries, but at huge economic cost. Okay, the second reason is that there is fear. I mean, obviously there's also fear in the market, but one thing good is that this fear actually will allow countries to kind of contain it. So this fear has spread, and as you can see, these are some of the countries. This is not an exhaustive list. This thing keeps on rising, but in a way, ironically, it's good that there's fear by governments and even society of this virus, and being on the lockdown, almost 1/4 of the world GDP is on lockdown. And again, this is a moving number. It's probably going to hit 1/3. So you don't have to ask me if there's a recession, global recession. There obviously will be when you see 1/4 of the world is not doing anything or staying at home and on lockdown, and this number keeps on increasing. So why do we come to this point, that by having fear in society we can contain it? Again, social distancing is the only way to contain it. So by having more and more lockdowns, although it's really bad in the near term, but that's one way to kind of contain the spread. Okay, I'll move on. Okay, but this is probably the most important chart right now. If you want to time the market, if you have to, is this chart. So this is basically the number of new confirmed patients. This is not the total. The total will always be rising, but what everyone wants to see is just the peak in new confirmed cases. Again, there's no good news here. We just crossed 60,000 globally in the last 1-2 days, and it actually doubled in a week. So if you want to time the market, it's going to be, so long as this number of patients globally keeps on rising, I'm not sure what's the number obviously, but so long as there's no pause in this or sliding, or it slides down, it's going to be hard for the market to sustain any rally. Because you can think of this chart as not only new patients, you can think of this like the economic pain that a country has to go through. So the higher this thing goes up, then the more and more economic restrictions, the more and more economic pain, there will be incurred. Like, just to give you an example, just like Malaysia, they've already stopped. All businesses have virtually stopped up to April 14. And if they cannot contain, this could spread to even end of April and so forth. So long as this thing doesn't get contained globally, you're going to see more and more economic pain, and of course not going to be good for the market. So that's why it's hard. Without this peaking, it's going to be hard for the market to bottom. This chart just to show you, this is just the US. US keeps on rising, and even after Italy did a lockdown, the number of patients, it took like almost weeks or before it peaked. So US is not going to peak, and the lockdown was mainly in California and New York. So any peak in US will be probably days or weeks away. Okay, and the other positive is, of course, we have record low interest rates. Record low interest rate is not going to spread. It's not going to stop the virus. We all know that. The Fed cutting interest rate is not going to doesn't mean that the virus is going to stop with low interest rates. But it's still a stimulus. I think good to remember that low interest rates means there's a stimulus for the economy, and of course it's positive for asset prices. Everything is benchmarked against it. When interest rates are low, it will inflate all kinds of asset prices. And again, you also make equities attractive. If bonds are not paying anything right now, then obviously equity will look attractive, especially those that have dividends. And the most valuable asset now is virtually yield, with everything now priced to zero in terms of interest rates, especially in the developed countries. Any asset with yield now is going to be the most valuable item right now. sorry, this is actually 4. Okay, but anyway, the other reason why, excuse me for the reason, actually 4. Then the other reason why we think is that if it, okay, I'll explain a little bit on this chart, maybe a bit confusing. So basically, these are the worst 3-month performance. So in terms of performance, we are probably the 12th worst all-time fall in the last 3 months. But if you look at the 12-month returns, again, this is not a forecast, obviously, but what it does show you that it does pay whenever whenever there's a major sell down, it does pay off on the 12 month and even on the 6 months. Again, it doesn't mean that we're not predicting that by now you're going to get like 50% average returns, but it just shows that the odds are with you that you will get some return. The only time when after such a major sell-off over a 3-month period, it didn't work out was in the Asian crisis. I think after the first sell-off, the market did even more. But apart from that, most times in the 3 months, it's like 50-50. Sometimes it's up, sometimes it's down. But in terms of 3 months, you do get good returns whenever you get a 3-month sell-off like this. So these are basically the top 15 worst 3-month performance, because we are doing more. We don't want to do a daily; it's too volatile. So if you look at these are the top 15 worst 3-month performance. So also example, November after the market fell 45%. That's to explain the chart. You can see that over in 12 months time, the returns was 18 and 16. Again, this is not a forecast, but you can see most sell-off episodes, you do get a good return. This is nothing much. It's just to show you where we stand in this sell-off. Most sell down historically, some have fallen 45, 30, even 50. So this is about 25%. It's not as bad as the recent, but again, this only so far been 3 months. Okay, then the other reason is of course the valuations. Again, you said it 4.5 or 5.5 is mainly because we've always talked about valuations, but again, the valuations are really cheap and we are reaching global financial crisis levels. So in terms of PE ratio, again, you can argue whether the market is going to cut rates, cut their earnings, but at the present time, you can see the valuations are back to the global financial crisis levels. Price to book is even worse. Price to book is at all-time low. Dividend yield is not as high as 2008, but because 2008 interest rates were also higher. But if you adjust the dividend yield for the kind of interest rate environment right now, again, we are also hitting kind of a global financial crisis. So obviously the market is cheap right now. Anyway, those are some of the reasons why. I think there was one chart, but the other chart actually was missing is the fiscal stimulus. We actually have a lot of fiscal stimulus. I think the chart was missing, but there's a huge amount of fiscal stimulus globally. And that was actually the 4th reason. Apologies, I think we had an error on those slides there. But anyway, I'll move on to Wei Ren. He will explain on his technical views.
All right, thank you, Paul. Hope everybody have a great Monday evening. So today I'll be sharing some of the STI mainly. So before we carry on, let's have a 2020 Q1 recap summary. So prices have been forming a weekly double top at 3289, shy of 11 points of the psychological high of 23,000. So this is quite important. So the 11 points actually make a difference, and then market came crashing down sooner than we expected. So subsequent sell down below 3,000, which was 2 weeks ago, conclude the wave 3 extension movement. So this one, this I will be sharing on my chart later on the monthly and the weekly chart. So based on the wave analysis, we expect further downside after a rebound, be it today or tomorrow. So next slide. So let's have a recap on the last market outlook that we have on 4th January 2020. So based on this current chart, based on the past chart, it's not updated. So based on past chart, the STI, the B has already topped up in 2018. So but however, what is missing is the rebound didn't happen as we expected. We actually expected a rebound before a red sell down near the upper echelon of 33,000, but it did not happen. So for the next slide. Next slide. Yep, thank you. So for next slide, it actually shows. So based on the 4th Jan chart presented on our last outlook at the start of the year, the forecast, like I said, the forecast initial rebound did not materialize. But the sell down came faster that we expected due to the COVID-19 outbreak. So from this chart, you can see that there's a strong bearish candle, monthly candle, crashing down till break below the 28,000, break below 3,000, and then subsequently close it at 2,228. Okay, next slide, please. So so based on the updated chart analysis on the money chart, much clearer wave analysis, the monthly regular flat corrective wave based on the last analysis is still in place. So while we zoom in, the third wave for the Y leg is completed, and the rebound is currently forming a potential fourth wave. However, do not take the rebound as a recovery, because fourth wave is normally the corrective of the impulse leg. So we believe that price is going to fall further, and the target is at 1564 to 1709, or if it break 1000 psychological level, we can see that price travel further to 887.69. Okay, next slide, please. So based on the weekly rebound, okay, so this is the weekly chart. So the weekly rebound has formed a piercing line candlestick formation. However, price still need to break the monthly support at 25,331.19 to confirm the rebound. Although there's a gap down as of today on the daily chart, we should see a slight bullish recovery at 2372.00, which is 50% of the whole piercing line candlestick formation. So if that level of 2372 is broken, then the STI is set to resume its downside move, and the piercing line, it will be taken as the fourth wave of the Y leg. And then once the fourth wave is confirmed, then we'll see that on the money chart that we set the price target between. Sorry, give me a moment. Between 1564 to 1709 or 887.69 will be materialized. So let's move on. Next slide, please, on the DBS. So for DBS, okay, sorry. So in my previous report dated on 18 March, titled "The Banks Had a Similar Sell-Off in a Similar Fashion," should you require to go back to read the report, you can do so by visiting our website at stockbnb.com under Technical Pulse. So I shall summarize my report. So based on my report, the wave analysis on DBS has played out accordingly as of other two banks, but due to time constraint, I only pick up DBS because DBS has a very good example. So we expect DBS to further climb up towards $20 as it played out. Price did rebound at $70 at 04 cents, which is the 161.8% of the extension, which is the minimum extension level for wave 3. So DBS, we are expecting it to climb further, but please do not, like I said, please do not take the rebound as a strong bullish recovery, because it is a corrective leg of wave 4. So therefore, once it hit $20 to $21 between this region, we believe that will be a strong sell-off towards $30.29. Okay, or minimum $15.19 to $40.81. So with that, I end off my technical presentation. So I move on to the next presenter. Thank you.
Okay, thank you, Warren. I hope everyone can hear me clearly. So I'm Wee Kwang, and tonight I'll be providing an update on the banking and finance sector, as well as our picks within the sector later on. First up, on the Federal Reserve's double emergency rate cut in March will probably worry many investors holding on to the bank stocks, not just in terms of the frequency, but also in terms of the magnitude. So we can see that the double rate cut at 50 and 100 basis points respectively actually brings the Fed fund rate down to the range of 0 to 0.25%, a level actually last observed after the 2008 global financial crisis. And we're all worried on how it will actually affect the local lending rates, which eventually affects the net interest margins of the banks itself. So next. Okay, so when we compare our 3-month SIBOR and SOR against the Fed rate, what we noticed is that apart from the period between 2015 to 2017, right, both SIBOR and SOR actually moved largely in tandem with the Fed rate. And if you remember, from 2015 to 2017 was actually the period when the market had already started to expect some interest rate hikes. So SIBOR and SOR actually moved ahead of the Fed rate hikes that time. So now we're all trying to guess how the recent rate cuts will affect SIBOR and SOR as well. An interesting thing we have observed when we zoom in, okay, so next. Yep. So when we look at this chart, right, only to show only the 2020 data, we can see that SIBOR and SOR did fall off slightly around the period of the interest rate cuts, but both of them actually have rebounded slightly since then, which might help to hold up some margins for the banks in the near term. As such, the most important question that should stay on investors' mind will be on how the SIBOR and SOR rates will stabilize moving forward. Say, the short-term effect of non-NIM, right, will be muted as SOR and SIBOR stays resilient while stabilizing. There will also be a lag effect of 1 to 2 quarters before we experience the full effects of the rate cuts due to the cycling of loans and deposits under the prevailing interest rates. However, if we were to compare for the historical NIMs, both SOR and SIBOR has hovered between 0.2 and 0.3% during the previous period when interest rates was between 0% to 0.25%. In such cases, right, we can see that the NIM, the average NIM among the banks are about 15 basis points of the current average NIM reported in the fourth quarter of financial year 2019. In such circumstances, we can expect up to 20 basis point compression by the third or the fourth quarter of this year. But hopefully for the first and second quarter, because there's some lag effect, we hope that it will be able to buffer the adverse impact that we are expecting to observe later on in the year. Okay, so next. Okay, so now we will provide a brief snippet on loans outlook. So as MAS latest data for February's loan data will only be available tomorrow. So today I can only show up to the January's data. So based on January's data, we can see that loans growth have been hovering around the 3% level since 2016, with the exception of a good year in 2017. Currently, data shows that loans growth is dipping below the 3% mark, but with the current macroeconomic conditions, I think that investors aren't really expecting any loans growth at all for this year. Instead, what most of us are concerned about when we talk about the loans will be more of non-performing loans. So whether the allowances as a result of the bank's loan quality will affect the bank's earnings. Next, on the right side of screen right now, we can see a breakdown of the domestic banking unit loans. First part is the business loans. I think most of us are probably concerned recently on the exposure to oil and gas industry, given a concern arising from oversupply as well as some price war in the market recently. So on screen now, the banks do not actually specifically classify the loans into oil and gas industry, but we do not really have an accurate picture on the size each bank's loans to the oil and gas industry is. But after talking to each of the banks, they did mention that the exposure to the industry is less than during the 2016 oil debacle, meaning to say that it is roughly at 2% levels, of which most of them have already been provisioned for credit deterioration previously. So I think there's not too much to worry about for the oil and gas industry. But as business loans as a whole, we know that across the board, SMEs are likely to be affected the most as a result of the current COVID-19 pandemic. So from the resilience budget announced last Thursday, we know that there are many aspects aimed at helping these businesses. As such, we will likely be seeing the banks working with MAS to mitigate the economic impact brought about by the current pandemic. This will allow the banks to have some ability to restructure loans, such as granting a longer loan repayment tenor and deferring loan repayment, which will not be classified as impaired loans, so they will not affect the bank's earning. Next, we can see that for the consumer loans, all right, we can see that housing loans is the next biggest piece of the pie, consisting about close to 30% of the entire domestic loans. Okay, so without going into too much details, we know that the resilience budget announced was also aimed at helping individuals to keep their jobs during this challenging time by co-funding wages with employers and also multiplying the amount that we receive through GST vouchers, etc. So this will provide some safety net for the more financial challenging period. As such, we should not be seeing default rates spike within this segment. Hopefully, with the help of the resilience budget, the bank's credit costs will be able to come under control going forward. Yeah. Next. So I will now pass the time on to Paul to talk about the technology sector.
Yeah, okay, thanks. Thanks, Vikram. We just run through the electronic sector, hardware. After all, Singapore doesn't have any software. Okay, if you look at the chart and even speaking to some of these electronic companies, the demand drivers are still intact. I think, so if you look at the data, even handset productions in China was doing well. Semiconductor is actually really strong. The demand is all picking up. The only problem we have right now is the transportation and some supply disruption. So there hasn't been any cancellation in orders, especially for semiconductors. But I think the two main problems now, or one in particular, is actually Malaysia. Malaysia there are two scenarios right now in Malaysia. So you either shut down your factory if you're doing electronics, or if you're doing healthcare, maybe you can still keep it open, but you might only keep up to maybe 20-30% utilization capacity. So that is the problem now. So there's a temporary major disruption for all those electronic companies with Malaysian facilities. The best is if you maybe can keep it, even the big multinationals can only run 20-30% of their capacity. So it's going to be really tough right now. But we still like the sector. I think the orders did not come down, and actually even went up. We spoke to some, and when the COVID-19 happened in China, actually all the laptop sales started to fly off the shelves. They were actually sold out as everyone started to work from home. Of course, cloud computing demand is strong with the current scenario, and all the companies, telcos, handset manufacturers are not pulling back because they know around the corner is 5G and with mobile computing. So the demand is actually relatively strong considering the circumstances. And that's why we still like the hardware sector. Although the biggest problem now is, like I said, Malaysia and even transportation. So even if you can ship the goods, there's not enough planes out there to transport the larger items. Small items are fine. So it's a supply shock and not a demand issue. So that's why we still overweight the technology sector. Okay, on my next slide, on the telco, this is essentially, because we have a separate slide on Singtel, so I'll just tell you what we think of Singtel right now. So as you can see, Singtel, the group earnings is actually coming off pretty sharply, and they actually kind of downgraded their forecast for 2 consecutive quarters. And the big problem we have for Singtel is it's not Singapore, thank goodness. The problem is actually Australia. Australia, almost all segments are weak. Broadband is weak, mobile, enterprise is all weak. There are 2 main issues here in Australia, at least for Singtel. First is the NBN is a structural headwind. Again, a bit complicated. NBN, you can think of it is like your NetLink version. So what has happened is that they used to sell fiber using their own network, but right now the government does it, so they lose a bit of competitive advantage. So that hurts their broadband and even hurts their enterprise business. Then mobile is going to face competition as TPG and Vodafone undergo their merger. So and Australia, as you can see from here, the numbers from Australia, it's a huge part. It's about 600 million Australian dollars at EBITDA on the left-hand side. So you can see that Australia is a big contributor to Singtel earnings, and that's why Australia is the one going to hurt, going to be a bit problematic for Singtel. Of course, they also liquidated Hook recently. That was 25 million gone. But anyway, then we move on to the associates. India is doing really well. I think the competition has kind of been muted. But the problem is that Telkomsel, the biggest contributor to earnings for the associates, is facing competition outside Java. Outside Java island is really their stronghold, because most of the competitors in the past were very well built up the network in Java, but outside Java, they were not so strong. And again, like we mentioned earlier, so we like the telcos, but our preference is essentially StarHub and NetLink. We will discuss, elaborate more on the later slides. Okay, in terms of aviation, okay, let me just get this out. We do not cover SIA. I think the chart on the left, I think we showed in our previous presentation. I think after 20 years, even before the recent sell down, this share price has not gone anywhere. So that's why we don't really cover SIA, because the competition is too tough, and you got all this volatility in oil price. Of course, there are certain periods of fun. I mean, like this chart, like this spike up here is fun, certain part. So you can treat it as a trading stock, but we don't cover it because we always feel that SIA is structurally challenged. And as you can see from the share price, after 20 years, it hasn't gone anywhere. Okay. Anyway, we've been asked to comment on the recent rights issue. Again, let us state that we do not cover, but I think there are certain points that you can take from the recent rights issue. The most important one is the TERP. TERP is fancy name for theoretical ex-rights price. So basically, what it means is that if you don't, assuming the rights issue is completed tomorrow, the share price for for SIA will drop to 4.12. So basically what it means is that if you don't subscribe to this rights issue, your share price from 580 will drop to 412 the next day. So number one, so for us, we are a bit worried about SIA, and our preference is really to not to because we worry that a lot of investors may not be able to participate in the rights issue. Because for every share that you own right now, you virtually have to pay 4,500. I mean, you really lost money, and then for every one lot of SIA shares at 580, you actually have to fork out another 4,500. Otherwise, your share price is just going to drop from 580 to 412. Again, sorry, it's a bit complicated, but anyway, the other thing, that's on to, I don't want to dwell too much on it. There's also a mandatory convertible bond. Our view is, if you're a retail investor, just forget it. Don't even come close to this MCB, because basically it's like a free loan. So this one, Temasek can provide this free loan, but as a retail investor, I think you don't need to do it, because this means is that this mandatory will only give you the right to convert. If I'm not mistaken, it's only after the 10th anniversary. So you can still do the rights issue, but you don't have to take up this convertible bond, because it's mandatory. So it's technically shares, but you can't, and there's no interest rate on this. So for the next 10 years, you're not going to collect any interest rate. And it's good for SIA because you're not Temasek underwrite everything, even give a free loan through this MCB. The last point I want to make is that the problem with this bailout, which is good, I think good for the country, good for that they bail out SIA, but it also means that competition is not strategic, because if Singapore government bail out SIA, then other governments start to bail out, then the competition is no longer based on profit, it's just for strategic reasons. So there's no real clearing of this whole competitive landscape for airlines. But anyway, without going to any more controversial comments, I'll just move on to the next slide. Okay, in terms of land transportation, again, it's also challenging. Okay, anyway, this two slides, this is essentially a Comfort Delgado strike. The left side is basically the rail. If you can see the bottom, this is the rail traffic in downtown line, northeast line. For the first time ever, this is as much data as I can get, but the first time ever, you can see that there's a decline. So it's going to be challenging. And okay, this is a bit of a pun, but you can so the red line here is actually rental cars. You can consider this as your Grab. So this is the number of Grab cars out there, and the blue line is actually the number of Comfort taxi, and not just Comfort. So in 2015, there was all the taxis had one competitor, so 1-to-1. Then 2016, there was 2 Grab cars to 1 taxi, so it was really very tough. Then 2017, it jumped up to 3. Then 2018, it jumped up to 3.2. You can see there's not much change. At this point, we were actually quite bullish on Comfort because the government was imposing some regulations. So we thought that could kind of hold back a bit of competition, which it did. But after that, you can see the red line here, it started to climb back up. Then right now, the competition is, that means that for every 1 taxi out there, there's 4 Grab cars. So I think even Bruce Lee can't fight with 4 people at the same time. So it's really, really tough when you're going to have this type of competition. But okay, then we'll move on. Okay, and the marine sector, this is the last part for me. I think exploration, you can forget. It's not going to happen. No, there's not going to be any exploration work for the oil and gas sector. Even before this whole oil price falling down, you can see the order books for Keppel and Sembcorp Marine was already shrinking. This I'm just taking it off from we don't cover both, but anyway, this is from the latest data order book. I know there's a lot of interest, so we just try to discuss a bit. So you can see that it's already it was already falling even before the oil price collapse. So you can just imagine what's going to happen with the recent price collapse. We don't cover all. We don't know. We can't give a forecast, but if you can see this chart, oil price and inventory actually move quite in line. So if you want oil price to really recover to more sustainable, the good old $100 plus levels, then I think the US inventory needs to, this is an inverted curve, an inverted chart. So inventory actually needs to go back to around the 300,000 plus, but right now it's about 400,000. So I mean, if you really want to play oil, probably that's one thing to watch for, which is the inventory. But again, our conclusion here is that even before price collapse, the order books are already shrinking. So it's going to be very challenging for the marine sector. And maybe it could be a catalyst for a merger. Okay, I'll move on to Natalie. She will discuss on the REIT sector.
Hey, hi everyone. So my first slide is actually a little health check on how the property and the real estate, property and the REIT sectors are doing. So the blue line in the top left-hand chart shows the REIT index that has fallen in line, very much in line with the market, the STI, which is the red line, and the real estate index, the developer index, has all along been underperforming the STI, and it is also currently now still under the STI line. So more or less in line, the fall is in line with the markets. REITs have pulled back to the tune of about 20 odd percent. So moving on to the middle graph, this is the FTSE REIT index, and currently the dividend yield has expanded due to the falling in prices. So currently dividend yield is about 5.6% for the index, and this compares to the average dividend yield in 2019, which was 4.6%. Similarly, the dividend yield spread also expanded, and currently it's at 4.2%. And this compares to 2009's average of 2.6%. And this, at the current dividend yield spread, it is at the positive 1.1 standard deviation level. And this compares to 2019, where we saw standard deviations for the yield spread ranging -1 to -1.5. So it is a much better entry price for to enter the REITs. So the last chart is SAW. So as we know, we spoke about it. The Fed rate is down 0.0 to 0.25%. After the 150 basis points cut, and similarly SAW as well as the 10-year SGS. Moving on to my next slide. So the first chart on the left actually shows us the correlation between the real estate index, which is the light blue line, with the 10-year bond yield. So it's actually an inverse relationship. The red shaded areas, the pinkish shaded areas actually show times where the interest rate was increased, and this was followed by a sell down in the REITs. And the pairs of upward and downward pointing arrows show the periods of reduced interest rates, which was a tailwind for the REITs and hence upward share price movement. So currently, this situation is different from the GFC, even though the sell downs have been compared to the GFC level or impact. First of all, we note that during the GFC, actually, it was characterized by an increase in the interest rates and hence a massive sell down on the REITs. Whereas this time around, the low interest rate environment, which is supposed to be a tailwind for the REITs, it compares to right now. So in terms of portfolios of the REITs, currently REITs are doing better. In 2019, there were lots of yield accretive acquisitions, and during these acquisitions, REITs actually had the opportunity to diversify their portfolios, which means for better spread of income from different geographies. And some REITs even made minor improvements in their portfolios, such as reducing the percentage of unencumbered assets. Not to mention that after this time, there has been a longer track record for the REITs. So if you compare now to GFC, REITs are in a much stronger position. So in terms of 2019 was a very strong year of acquisitions for the REITs because of the lower interest rate environment. So however, this time around, even though the low interest rate environment is still going to be positive for the REITs and financing cost comprises 30 to 40% of the REIT's expenses, we expect acquisitions to pause. And this is largely because of the leverage limits that REITs are subjected to. So in Singapore, this is 45%, and REITs usually acquire by taking on a percentage of debt debt and equity. Yeah, so currently with the sell down in REITs, it makes issuing equity more expensive, and hence we expect that the acquisitions will be paused until probably late 2020. Also from the ground, we've spoken to some of the REIT operators across all the sectors, and most of them echo the same thing. We will be expecting more renewals and actually slower leasing, so slower new leases to be signed. And this is also due to, especially if especially if it is the MNCs that are trying to lease the space, where they have overseas team members who need to view the space and tour. So in a nutshell, just more renewals and less new leases. So moving on to the next slide. We're going to our subsectors. For commercial, which is overweight for us. We note that currently the first graph actually shows you the 3-year rental reversion cycle for REITs, for commercial REITs. So usually commercial leases are 3 years, and hence it's a very cyclical effect. Currently, the blue line actually shows the rents, the market rent now over the market rent prevailing about 3 years ago. So we are still in positive territory, as seen from the blue line being above the zero. So that means that we can still expect some positive rental reversions on the leases that are expiring currently, as they were signed over the rents, the trough rents in 2017. So from the ground, we spoke to OUECT, and they have managed to renew about 20% of the leases expiring this year at positive, high single-digit rental reversions. So still quite positive. One risk for this commercial sector is that given the business continuity plans enacted by most of our corporates, we also see some remote working from home. This actually raises the risk of corporates rationalizing or right-sizing the space that they require. And this pretty much is enabled by technology and is accelerated due to this whole COVID situation. And however, we spoke to some of the commercial operators, and they expressed that yes, actually right-sizing has been taking place all throughout the years. We experienced the GFC as well as the Eurozone crisis, and also some tenants do right-size their space, and it is a risk. So they are trying to say like most of the rationalization of space has already taken place, but nonetheless, it is still a risk that we think there might be further consolidation of space or flight to efficiency in terms of space. So positive rental reversions, as mentioned, due to the 3-year rental reversion cycle. And however, if we just do a quick comparison to the GFC time period, during the GFC, we saw that occupancy fell as well as the rental index. However, in that time, rents were at the peak in 2008, and there was also substantial supply coming onto the market. So currently where we stand in 2020, 2021, the supply coming onto the market is very benign. So that will also help to keep the rents stable. Okay, moving on to our next slide. We're talking about the retail sector right now. Last year, there was quite a substantial amount of retail space coming onto the market. However, from our graph, the first graph, we can see that the supply was actually very well taken up. Occupancy rebounded, so did the rental index. So compared to this year, that the supply coming onto the market is actually very benign, and it is mostly coming as part of integrated development, so not direct competitors of our standalone malls. So that's not a real worry for us. And in 2019, our REITs managed to secure positive rental reversions in the low single digits, and this was despite weaker tenant sales, which overall still outperformed the RSI index. So in this current situation, some of the operators, for example, the suburban mall operators, they outperformed the central mall operators. So FCT, Frasers Centrepoint Trust, they reported footfall falling by about 10 to 20% at their suburban malls. And this compares to CMT, where they saw footfall actually falling by about 50% during the first 2 weeks of February. And amidst all this, the government's budget, we actually see the landlords emphasizing a symbiotic tenant-landlord relationship, and the focus is to help the tenants pull through this difficult period. So for the landlords, there will be they spoke to Frasers, Centrepoint Trust, and CMT. They will be passing on the property tax rebates onto the tenants, and they also have offered rental rebates to their tenants. For CMT, it's ranging 1.5 months to 2 months, and for FCT, it's about 1 month. And they will be releasing 1 month's worth of security deposits to help tenants ease their cash flow. Rental waivers for entertainment and enrichment tuition centers are also offered, and due to the closing of these establishments. So overall, we feel that the sector that will improve, the malls that will improve the best and the fastest are the suburban malls, and this is due to the necessity spending, and more likely than not, Singapore will be relaxing the mobility in Singapore before opening the borders to the international borders. Okay, so moving on to the next sector. Our industrial sector, it's pretty much a waiting game. So rents have been bottoming out for the past since 2017, and it was slowed because of the trade war last year. Once again, the macro supply for this sector is very positive. It's very little, and most of it is actually coming on from the flatted factories asset segment, and that is the area where we will be seeing a lot more competition, and probably rents will be under pressure for the flatted factories. However, REIT operators or industrial REIT operators, they have been actively trying to redevelop, reposition their assets, and we have seen Mapletree Industrial Trust as well as Ascendas REIT announce repositioning of their light industrial assets to high-tech, high-spec assets that will command more rent and also ease the supply in the light industrial segment. So speaking to A REIT, they have not actually received any inquiries on rebates or any plea for help. They will be passing on the rebates to some of their retail tenants in their business parks, etc. And it's pretty much business as usual. Not to say that there will not be an impact from COVID, but it is still it has yet to be seen. It might be a lagged impact. So moving on. Moving on, I think we missed a slide for hospitality. Yeah. Okay, sorry. So for hospitality segment, the graph on the left actually shows us data of the international visitor arrivals as well as the RevPAR until February. So in February, actually, RevPAR fell by 41% and visitor arrival fell by 51%. And Paul is right. In March, the IBA actually fell to 90%, fell by 90%. So initially, the hospitality sector had very positive muted room supply coming onto the market. It would have helped the RevPARs. However, this was overshadowed by the COVID situation. In February, hotel occupancies for hotels were between 20 to 50%, and the service residences occupancies were in the range of 60% to 70%, and this was due to the longer staying corporate clienteles. So what's happening right now is that some of the returning residents are actually choosing to serve out their stay-home notice in hotels and service residences, and this has helped to fill occupancy. So one of these operators is OUE Commercial Trust. Their hotel in Orchard, which is the Mandarin Orchard, Singapore, they have kept one block just to service or just to be rented out to people who want to serve their stay-home notice in hotels. So one thing to note is that even though hospitality sector was very much hit in the sell down, one thing to note is that most of the hospitality or Singapore-listed hospitality REITs have revenue structures with at least 50% from stable sources. So stable sources are defined as those assets that are on master leases which have a fixed rent, as well as those that have a minimum rent kind of provision in their leases. And while we have traditionally favored diversified REITs, meaning REITs that have multiple presence in multiple countries, this time around Singapore-centric REITs as well as diversified hospitality REITs are both equally hit due to the international nature of tourism. And what we can see is that while the government has offered a 100% property tax rebate, it depends on whether or not the REITs will be passing on their tenants to this rebate to their tenants, especially for those under master leases. If they don't, they can use this rebate to help their DPU. But as seen, I think mostly they will be passing it on. And also we can expect them to be accelerating their AEI and maintenance timelines to coincide with this lull occupancy period. And thereby future-proofing their assets for when the market starts to recover. Okay, so we move on to our property sector. So for February, the transaction sales have actually been very positive, as seen by the graph on the bottom left-hand corner. The property sales actually increased by 104%, excluding the EC, which there was pent-up demand because in 2019 there was only one EC launch. So including the EC launch, the number of sales was actually 188% higher than the same period 1 year ago. So we do expect that the ABSD penalties to continue to pressure developers to keep to their launch timelines, and we expect property prices to hold steady due to the committed development costs. So with that, the lower interest rates should be able to help with the transaction volume. Okay, and moving on, we'll go into our stock picks. So our first stock pick is Ascendas REIT. We like Ascendas REIT for the reasons of their size as well as their diversification. So their assets are worth $12 billion, and they have 197 assets across 5 asset classes and 4 countries. So as you can see from the pie chart on the left, about 68% of revenue derived in Singapore is actually from the in-demand business parks and high-spec asset classes. So these are the asset classes that traditionally have more demand, and there's also very, very little supply coming on to the market. And due to their size, they also have very low tenant concentration risk. So no tenant accounts for more than 4% of MPI. And their size actually allows them to undertake redevelopment or development projects with minimal impact to DPU. And in 2018, 2019, Ascendas REIT has actually been aggressively trying to diversify their assets. So in 2018, they actually acquired 38 UK logistic assets. And 2019, we saw them enter the US markets with the acquisition of 28 US business parks. So in a way, their size actually allows them to make such large transactions in a very agile manner. And this is actually very beneficial for a REIT because it allows them. Because when they do enter a new potential market, their size or their investment shows that they are in it for the long haul, and that will help to attract some of the local tenant expertise. So we have, due to the recent decline in share prices, our rating is now changed to a buy with a target price of $3.31. And moving on to our next stock, which is Ascott Residence Trust. So Ascott is in the hospitality sector, and they own primarily, most of their assets are actually service residences. So we like them due to the stability from geographical and lease structure diversification. So the first pie chart on the left, Ascott actually has 3 types of leases. The first one is a master lease, denoted by the red color area, and then it's the minimum management contract with minimum guaranteed income. So these 2 leases are more stable kind of leases that have a fixed floor rent. And then the more variable one, which is also considered their growth kind of revenue, is the management contracts, which are more variable in nature. So for Ascott, they typically want to maintain a 50-50 split between the stable income and growth income. And in terms of geographical diversification, the pie chart on the right actually shows you the breakdown of their presence. So as mentioned, if you recall earlier, service residences are actually outperforming their hotel peers. They have the occupancy at SRs are around 60%, and this is higher than the industry average of about 20 to 50% for hotels. So a brief chat with the Ascott team. They did share some color on how the other assets in other geographies are doing. So for example, in China and tier 1 cities, for the period of February and March, their occupancy is about 60 to 70%. In Europe, it's about 70% for February, and in Singapore, it's about 60%, and they see a window of opportunity due to the closure of the Malaysian borders and alternative income sources such as people serving their stay-home notices and staycations. So another catalyst or avenue of growth for Ascott is the increased brand recognition and loyalty programs. So Ascott sponsor is the Ascott Limited, which is a wholly owned subsidiary of CapitaLand. They are aggressively growing the number of keys under management, which means the number of buildings that actually carry this Ascott brand. So as they grow their loyalty base and as they have more brand presence globally, this will also benefit all the Ascott branded service residences in ART's portfolio. So our rating for Ascott is a buy with a target price of, actually this is wrong, sorry, our target price is $1.54. So moving on to Frasers Centrepoint Trust. So this is our pick, our preferred pick in the retail sector, for reasons mentioned before, that we were expecting a better and faster recovery of suburban retail malls compared to tourism-dependent central malls. So first of all, Frasers Centrepoint is very much anchored by resilient necessity spending, and they have both organic and inorganic growth catalysts. Now, first of all, they have the three largest malls in their portfolio, which are Causeway Point, North Point, as well as Waterway Point. They are projected to have a 67% jump in the number of HDB units surrounding these malls. And so that basically means that more footfall and more tenant sales as these HDBs are open. And these three malls are also beneficiaries of the URA master plan. So and moving on to their inorganic growth. So they still have, there's a very, very strong sponsor alignment where Frasers Centrepoint Trust still has 3 more pipeline assets from their sponsor and 6 malls under the PGIM portfolio. So, and this acquisition of PGIM malls is actually quite imminent. So for Frasers Property Limited, which is the sponsor, together with the sponsor, they have actually started investing in this private retail fund, which is PGIM ARF. And over the years, they've actually increased, not over the years, just last year, they actually increased their stake in PGIM. So it went from a total of 66% to 74%, and now it's currently about 88%. And just about last month or 2 months ago, Frasers Property Limited actually announced the acquisition of the property manager. So what this means is that they want to have more visibility on the performance of the PGIM malls, which are Tiong Bahru Plaza, White Sands, Hougang Mall, Century Square, and Tampines 1. So therefore, we do believe that as the group has more visibility on the operations of these malls, we can expect it to be acquired relatively quickly. So our rating for FCT is a buy at $3.11. And moving on. The last topic for me will be CapitaLand. In 2019 was a very strong year for CapitaLand. They managed to achieve 10% return on equity after 10 years. And this was on the back of PATMI growth across all the segments, like their operating PATMI as well as portfolio gains and revaluation gains. So we like CapitaLand because of the high proportion of recurring income, which is income from investment properties, the rental earned on investment properties like the commercial assets and retail assets. And this contributes 80% of FY19's EBIT. So one thing good about having high recurring income is visibility that it provides. And it also helps because the revenues from the development sector are typically more volatile. So this actually helps to even it out. CapitaLand will also be, they are very strong, their revenue from Singapore and China actually accounts for 8% of their revenue. And however, they will be, the acquisition of Ascendas Singbridge actually allows them to unlock a new geography, which is India, and a new asset class, which are the business parks. So as we know, CapitaLand is a retail operator, commercial operator, but they do not have a presence in industrial assets until the acquisition in January of 2019. So we can expect them to unlock these or increase their presence in India as well as in the industrial sector. So our call on CapitaLand is a buy at $4.20. So I'll moving on to the next slide. We have Wee Kwang who will talk about UOB.
Thank you, Ned. Hope everyone still can hear me. Okay, so for under the context mentioned for the banking sector itself, which would be our preferred bank stock right now? Right. So for now, UOB remains our preferred banking counter. Firstly, with NIM coming under pressure, a bank's ability to lower funding costs can help to mitigate the prevailing low interest rate environment. So funding cost consists of your interest on your fixed deposits as well as current accounts and saving accounts, which we usually refer to as the CASA. And since we know that CASA provides the lowest interest for depositors, it represents the lowest form of funding cost available for the banks. As such, for banks that are already maintaining high levels of CASA ratio to total deposits ratio, right, they will have lesser flexibility to adjust funding costs downwards compared to those with lower levels of CASA. So in terms of CASA ratio, DBS as the biggest lender has the highest CASA ratio, while UOB edges out OCBC slightly by having the lowest CASA ratio based on the latest financial results. This will give UOB more room to lower funding costs, such as by lowering the interest rates on fixed deposits and etc., making it more resilient against NIM compression pressures. UOB has also guided for 3 to 4 basis points NIM compression for every 25 basis point drop in Fed interest rates, which corresponds to the 15 to 20 point compression that we have estimated previously. So next, when it comes to loans, okay, so for loans, right, all three banks have actually maintained similar levels of credit costs and non-performing loans ratio as of end 2019. It will also be prudent to assume that the extent of loan deterioration as a result of the pandemic will be of a similar extent across the three banks. So however, I think the market has been more cautious with regards to DBS when it comes to loans, because after the resilience budget, I think there was a report on SIE obtaining a $4 billion bridging loan from DBS. But nevertheless, SIA's bond issuance will be backed by Temasek, as previously mentioned by Paul. So I think we don't need to be too worried of any adverse impact on the loan that DBS is extending to SIA. So in all, we view that UOB will be better able to tide out this tougher time compared to the other two local banks in terms of both NIM as well as the loans. Okay, next. Okay, so apart from evaluating the respective banks' outlook, I think most of us are also in agreement that the current valuations for all three local banks are very attractive, and some of us may just want to buy into a bank and hold the shares over the long term for dividends. So in that respect, DBS may have more to offer for investors. Based on the price to book value, we can see that all three banks are trading at levels last seen in the global financial crisis, and that was when regulations governing capital positions of banks at the time was weaker. And when it comes to comparing yield, all three banks have actually increased their dividend payout in the latest earnings result, and have all cited that the move was in line with providing a steady and growing dividend payout, which might not mean much to us, but there is good reason to believe why a cut in dividend is very unlikely. Looking back at the historical data, we will see that the last dividend cut was undertaken during 2008 global financial crisis. While the scale of the current pandemic is greater than that of the GFC, But we can see that our current financial system is much healthier, unlike then, even when the credit quality of the banks themselves became suspect during that period of time. For this, we can take guidance from the Common Equity Tier 1, the CET1 ratio of the three banks on the right-hand side of the screen. You can see that compared to post-GFC period when there was only Tier 1 capital ratio, all three banks are maintaining a CET1 level that is comparable or even higher than the total Tier 1 capital ratio during the GFC. And bear in mind that the CET1 level is actually a more stringent criteria than that of the Tier 1 capital ratio. As such, in the short term, the yield on banking stocks remains very attractive for investors. So, but why DBS? So under the assumption that the payout maintains at the same level, DBS offers the most attractive dividend yield for investors. Although honestly speaking, it is already very impressive that the yield across all three banks currently is more than 6%. Then DBS is also the only bank that distributes dividends on a quarterly basis, which will mean that more frequent payout can minimize the impact of X-date on the share price itself. So investors can also better monitor payout rates every quarter instead of every semi-annually, so that they will be more certain of the dividends that they are receiving. And for my third stock pick, next, okay, is actually for SGX. SGX's business is split into three main pillars, with equities being the largest pillar, followed by the FICC, which is the fixed income, commodities, and currency, and then followed by connectivity, data and connectivity, and index as the smallest portion. So under the equities and FICC segment, the products include both securities as well as derivatives, which under normal conditions move in opposite direction of each other to give SGX a pretty stable revenue base. However, during the February and March sell-off, we have seen that the VIX index actually skyrocketed. The correlation between SGX's derivative volume against the VIX index means that the derivatives volume for March will likely continue to increase on a year-on-year basis as well. Furthermore, a securities daily average value has also received a big boost. For the first quarter in 2020, we can see that the SDAV actually increased 20 to 30% in the first 2 months. And for the month of March currently, based on current data we get, we are likely to see the full month's SDAV more than double, which is a very impressive number. As such, with both securities and derivative business thriving under the current conditions, we are likely to see SGX's earnings get a huge boost for the current quarter. Moving forward, with no end to the COVID-19 pandemic in sight, business momentum may also continue, making SGX a pretty good investment right now. So as you can see, as mentioned by Paul as well, out of all the STI stocks, SGX is the only one that is in the green. Okay, next. And that's what I have for my stock pick.
Yeah, okay, thanks. Thanks, Wee Kuan. I'll try and wrap this up in 10 minutes or less so that we can have Q&A. Okay, anyway, just a few slides for me, just a few. In terms of the other stock picks we like is NetLink Trust. I think for those who do not know, so NetLink Trust is basically the monopoly. It's a monopoly fiber provider. So if you have fiber, you go into your living room, you see that the little plug there, I think it's a green line. So that is theirs. You don't really notice them because you pay Singtel, then Singtel will pay them. So what happens is that every month, all of us has to pay $13.80 per month to them. And as you know, if you need your internet connection, you need to pay them. So just by that 1.4 million households, they collect about 231 million per year. So this is a very, obviously a very stable business. The impact from COVID is really minimal, unless you're assuming people kind of like opt out of internet, which is probably the other way around. And the dividends that they are paying is about 200 million dividend versus their operating cash flow is about 250. So if you want something very stable, so this is the stock. The yield is about 5.9 to 6. It's the growth won't be as good as when it got listed. As you can see, this number 98,000, 135,000. So what has happened is that fiber was just being laid out, so there was virtually no fiber. Then as fiber start to grow, penetrate deeper, then you will grow. Then this part here, FY 1920 was when StarHub disconnected their cable and everyone had to use fiber. So moving forward, it will be just based on household growth. But again, we are just buying this for stability, and we're not looking for like very significant growth. We just want to collect the yield and to collect that 1380 from everyone like us. Okay. Okay, I'll move on to prop next. This is a mid-cap stock, but the reason why we like it, firstly, for those who don't know, Propnex is a real estate agent. They're the largest. The reason why we like it is because of the impressive market share. So for every new property launch, one of them will for every two or one of them goes to, so they got like a 50% market share, and they got a 45% market share for any resale, and also 50% for HDB. So the reason why we like it is because it's really dominant. I think in Singapore very hard to find anything with a 50% kind of market share. There is impact from COVID, so you cannot hide that. The most affected is the resale. As you know, resale, you need to visit the place, and of course, new launch. I'm not sure how many properties you can sell via Zoom, but I think they did manage to sell a few actually. But anyway, you can't do a sustained selling of new launches just via Zoom. Buy $1 million home through Zoom. Okay, so there will be some impact, but we still like it, and we think that they will definitely, they have very high chance they will maintain their dividends. So the yield now is about 7.8. The reason why we think that they can maintain the dividends is that to keep this 7.8% yield, they need to pay about 13 million a year. I think every year their cash flow more than covers this, but if they miss the cash flow, they still got 82 million net cash in the balance sheet that they can pay for the next 5, 6, 7 years, even if there's no operating cash flow. And I think management wants to keep this as a high yielding stock. The other reason why, apart from the high market share, is that we like this company because it has very attractive ROE. I think this is a business where you really don't have to put any capital at all. The only fixed assets is actually only 3.5 million, which is basically probably a few laptops, 1 or 2 luxury cars maybe, but a few laptops and you're ready to go. So this business, they make almost 20 million and with very little assets. So that's why the ROE is very high, and it just generates a lot of returns without plowing in much capital inside. So that's why we like it for the yield, the market share, and also the attractive metrics. Okay, I'll move on to the next pick is Sheng Siong. Anyway, from our title, if you look at this chart, we've always mentioned that they are really outperforming the supermarket industry. So Sheng Siong grew 10% in 2019, whereas the industry was flat. So now on paper, they're really growing 10 times faster than the industry. Obviously, they're taking share not only from the other operators, maybe like Giant, they're also taking share from the web markets as more move into. As I think there are fewer web markets coming up, and also more people move into buy fresh food from them. Anyway, for this year, there'll be extra growth drivers for Sheng Siong. There'll be more people are stocking up. I think we can all look into our own fridge, then I think we realize that everyone is stocking up. So there'll be one extra driver for them. Of course, home meals. I think more people are eating at home, so that's also another driver. And the other one, maybe not so subtle and not so huge, but also the returning Singaporeans, who kind of also help boost their business. So the other drivers, these are the usual drivers that we've always been talking about them. They've always got store expansion about 5%. Then because they had a lot of new stores, so these stores start to mature, and then the sales per square feet will improve, and also the operating leverage. But these are the additional boosters. These 3 points here. And again, we only recommend because again, the other reason is, like as usual, they got very attractive metrics on net cash and ROE. The yield, of course, not as high as the rest, but again, the very visible growth. I think this year will be another growth year for them. Yeah. Okay, I'll move on to StarHub. I'll move on to StarHub. So for StarHub, sorry, give me a second. Okay, for StarHub, we still have we also have a buy call on StarHub. Anyway, what has happened for StarHub? So on the 14th of December, when TPG was awarded the 4th operator, I think the bottom fell off. You can see that there's a big battle there's a huge price war. I think pretty obvious. You can see that they used to charge $70 for ARPU. Then after the few years, it just collapsed to now about $40. So from FY 17, 18, 19 has been a very brutal year for all the mobile operators, because before TPG comes into the market, everyone just cut price. So as you can see, as a result, you can see the EBITDA for StarHub, apart from pay TV, of course, having issues, you can see that the earnings for StarHub has collapsed. I think if you look from here, about 700 dropped to maybe 600 plus, or less than 600. Then of course the share price is also half. So, but what we are saying is that we think it's relatively, we think that there's stability right now, and it's relatively immune right now to the slowdown. I think this is a recurrent business. Every month they collect money from their subscribers, and what is most exposed for them is probably the roaming business. I think roaming is a really high margin business because if anyone come into the country and roam, the money just goes to the bot. It's high margin, so you don't have to charge anything. All they do is just tap a bit on the network. The other problem they had was the pay TV content, but they're restructuring it, and the content cost will be more or less variable. And the other part will be the cost rationalization. So that's why we still like StarHub. This dividend yield 6.9 is committed. So they committed to a 9 cents, and we think we're not expecting spectacular growth, but we think there's a huge stability after the huge competition. Things are starting to stabilize, and the earnings will start to improve. And I think the last point I think is pretty obvious because they are going to joint bid with the 5G with M1. I mean, how much competition are you going to have when you're going to jointly bid something with your competitor? So we think that mobile competition will become more stable. Sorry, I have to press on because we're a bit time. The other one is Thai beverage. 2 reasons to buy. The valuations are attractive. Most consumer stocks trade high teens or 20%, and they are really dominant. Okay, most of the earnings come from spirits business, and they have like a 90-95%. They own the spirits market. Okay, in Thailand. So that's why, and we think that that the levels are attractive right now. Okay, I need to rush quickly because we're trying to take more Q&A. So the last one we have is venture. Okay, there will be, I think, first quarter earnings will be affected, although they have not announced anything, but it's pretty clear that production in Malaysia will be affected because of the closures and so forth, although they're not announced. So we're not really clear how much or if any, but we think there should be some disruption for them. But before this, I think they mentioned in their last briefing that they're going to have new products and also outsourcing from China. So we like them also because the yields are attractive and they have high ROE and so forth. So that's why we like the stock. But we do note that the first quarter we think the earnings will be a bit soft. But again, we think the levels are attractive right now. Okay, just some housekeeping things. This is our research team. And this is all our research is in this stocks BNB, and we'll go to Q&A right now. If we can't get any of your questions, you can just scan here and go into our website and ask us a question. We'll try our best to answer. So right now we will just try and look through some of the questions, and we'll try to answer as many as we can. So apologies if some of the questions were not addressed because we just worried that too many and okay, I will just try to go one by one. If we can. Hold on, I'll just try and build. Right, okay, anyway, for the first one, may I know what would your analysis of SIA? Okay, we don't cover SIA, so we don't look at price to book order, but my one shortcut answer to you is that the best time to purchase is maybe when it comes nearer to the rights issue date. Because my worry for SIA right now is not everyone's going to subscribe for the rights because it's quite a hefty amount to come up to subscribe to the rights, and there will be a lot of captive sellers. So there'll be a lot of sellers that because they cannot subscribe, as they come nearer to the X date, there could be some selling. So probably that will be the best time to buy into SIA, and not right now because this is a massive rights issue that they're undertaking. Reason five only for STI. Okay, there was one slide that was missing. It's actually the fiscal stimulus. It's in the deck. I think when I was pushing it. So these are some of there's 6 reasons why we think we like the market right now. Although like we mentioned, we still think there could be some selling in the near term. I think like we mentioned earlier, so long as the new cases do not peak, there's still going to be a lot of economic pain coming up, because if the number of new cases do not peak, what it means is that there needs to be more and more restrictions, more and more whatever work from home is going to be extended. So until you see the line that we mentioned earlier start to peak, then we know that there is at least that the economies can kind of heal, and they don't need to kind of impose more lockout periods. Okay, we'll try and run quick. Okay, any views on gold? I think I will leave this to Warren, our chartist. to answer if he can. Okay, I'll just move on to the next. Do you think Singapore and Malaysia economic stimulus will support the market? It will help, but like I said, if this thing is not contained, it will help the businesses in their costs. You know, as you know, if you're a Singaporean, the government virtually going to subsidize 1,001 to the companies that employ you at the maximum level. But again, this doesn't stop the spread. So touch wood, if the spread keeps on worsening, then we really have to even go into lockout mode. So the stimulus will help, but it doesn't solve the spread of this virus. So the only way to solve this spread of this virus is that basically you really have to collapse the economy. You really have to stop, have a lockout period, and like we showed you in the chart earlier, the way China, all the economic numbers just fell through the roof. So that is the only way to stop the spread. Although Singapore has done really well to kind of in a measured way, but so that the stimulus helps, but it's not going to stop the spread. I mean, that's our basic comment on this. What's the impact of moratorium on banks on NIM, and when do you expect this to reflect in? I will try and ask Wee Kong if he can answer this.
Yeah, okay, thank you, Paul. I think for the moratorium wise, right now, in the short term, I think it will not heavily impact the banks, because right now, most of it, I mean, the first part is definitely on the credit quality. So it will help to hedge against the deterioration in asset quality in terms of loans wise. But then I think that when the banks, the amount that they're actually offering right now is definitely a floating target, because I believe that as the government step in more and more, the banks also try to help out as much as possible. So in the near term, when this, I believe this loan repayment and everything will be also very lax, in the sense that longer tenor, maybe lower interest rates, to help I think the purpose is really to help the at-risk businesses during this period, this trying period. So definitely they are not in it to make a gain out of the small businesses. Yeah. Then as for the second question, I see there's a banking loans outlook. Are the data from the banks in Singapore only for the 3 big banks? Okay, so for loans, actually there are 2 kinds. One is the domestic banking unit, which was what we looked at, and there's actually the Asian currency unit. For all of them, they're actually consolidated by MES across all the different banks. So yeah, then yeah.
Okay, sorry, I was told, sorry, I forgot to repeat the questions. I thought everyone can see the questions. My apologies. We answered some questions. We didn't kind of explain what the question was. So sorry for those who listened but didn't get. Okay, anyway, their next question is any cover on telecoms? I think we already mentioned. I think speaking to the telcos, again, roaming is the biggest impact right now. We don't have the numbers. Of course, they won't disclose to us like how big is it. We just know that the margin should be good for roaming, but we don't think it will be like a 5%. We think probably less than 5%. So I think the telcos are relatively sheltered. Again, like we mentioned in the presentation, we are just a bit more worried on Singtel because of the deteriorating conditions for their Australian operations. But I think StarHub and Netlink, especially Netlink, I think Netlink is no disruption. I mean, hardly any disruption. Yeah. Probably people even want to subscribe more to their internet subscription. The next is what is the near-term support level for the STI? I will get Viren to try and answer our chartist.
Okay, I believe that I answered I think the near-term support for STI. For the near-term support for STI will be at I think I answered one of them. So let me get back the answer. So for the near term, we'll be seeing that for at 2385 at 50% and the 61.8 level. So reason being these 2 levels, if they are invalidated, so we will see if these 2 support levels are invalidated, we'll see a downside move again to complete the wave 5 for the last leg of wave Y. And then we believe that in the longer run, STI is going to fall below 20,000. No, I mean 2,000, 20,000 for doubts. Pardon me. So for 2,000, once the price breaks below 2,000, we'll be seeing near term at 16,000 to 15,000. And if there's an extension of the fifth wave, then we'll see that most likely will break 1,000 and then go to 800 level. So, but however, the 800 levels, most likely it won't go there. So yeah, that's my prediction. However, I still need more data to go on. And then I move on to the next one for gold. Gold actually has a very strong start for last week. Gold managed to rebound at 1,416, and then it breaks 1,640. So, but however, price has been rejecting at 1,640, and then we should be seeing price retreating soon. However, I believe that there will be one last leg based on the 4-hour chart for gold to reach 1,683. Possible retest the 1,700 psychological level. But do take note that for gold, still gold on the monthly chart is still on the corrective zigzag wave. So I would strongly suggest to buy gold at a lower price, preferably below 1,400. I hope that answers your question. Thank you.
Okay, we will move on. We're just running through the risks. Okay, the next question is, any timeline do you expect oil price to start to recover? Could maritime sector react first? Okay, this one is a tough. This one is a tough question to answer, because it's not just demand supply. There's a lot of politics behind the oil price right now. Because as you know, Russia and Saudi Arabia is slugging it out. So that's why it's not just an economical decision. Even if the economy recovers, if these two countries still want to produce non-stop, then it's still going to create a lot of supply disruption. All we can say is that it looks like oil could hit into the 1980s period, where it would just be like languishing at the $20-30 kind of level. But again, this is not a prediction, but it just looks that way. And marine sector, like we mentioned earlier, even when oil price was high, there was no orders. So when oil price is down, I'm not sure what's going to happen actually. We did speak to some oil gas person, so they just said that any exploration work, you can forget it. No one's going to do any exploration now with this oil price. So it's going to be very, very challenging. And we think that this may even kind of speed track the need for the both yards to kind of merge. I hope, because we don't cover this sector, this is just telling just our views of the situation. Yeah, I hope it helps us. Sorry, we just don't have that much clarity. In terms of how much of the sell down is due to margin calls and when can we expect slowdown in the sell down? We don't have that kind of data for Singapore. I need to do something. Maybe US might have so China definitely have. So I can't really answer you for the Singapore because they don't really have much data. In China, we know you can see the level of margin, and I think to a certain extent even US. Sorry, I can't really help you on this question. Apologies for that. Will COVID likely cause a long-term impact on REIT's dividend yield? I will move this question to Natalie. Yeah, Natalie.
Okay, hi. Sorry. So the question was. Sorry, Paul, can you repeat the question?
The question is, will COVID likely cause a long-term impact on REIT's dividend yield?
This COVID situation is actually I think it will only affect 2020 the most. For most of the REITs, the impact to DPU, will be seen mostly in 2020. And that being said, right, even a lot of the commercial REITs, they have locked-in leases, so that means there's no way that tenant can give back the space without paying the penalties, which are so meaning to say they are on the hook for the whole period. Yeah, so we do not expect it to have a long-term impact.
Okay. Yeah. Okay. I think we're already hitting the 8:30 mark. I know there are lots of questions. We will try to answer them in this community page, but anyway, we'll just take one last one. Really sorry, everyone. I think there's so many. We will try to put it in our community page here, and then hopefully you can get it there. Again, thank you for attending. I'm so sorry we can't answer all, but one last one is, for you, Natalie, what type of REITs do you recommend? Retail, office, industrials, and hospitality. Just a summary, I guess, for earlier presentation.
So for our subsector preferences, we actually prefer the the commercial, which is the offices, as well as the industrial. So in terms of industrial, during the GFC period, industrial REITs actually sort of outperformed the rest of the REITs, and basically for across all the sectors in Singapore, the supply condition, the macro conditions are very positive. There's very little supply coming on. Yeah. For hospitality and for retail, we are not so positive on hospitality due to the tourism impact. And for retail, it is the weak RSI and competition from the e-commerce players. But however, that being said, right, if you recall our presentation earlier, we actually do have preferences or stock picks within the hospitality as well as the retail sector, and this is because of the subset. This is because of the unique stock pick. Sorry, the unique characteristics of each of these REITs. Like for example, for Frasers Centrepoint Trust, they have very obvious growth catalysts, and the suburban malls are clearly the ones that are outperforming, and they were recording strong reversions even last year when RSI was totally negative throughout the year. I think the reversions came in around the 5%. Yeah. So yeah, selective stock picks are Ascott Residence Trust, as well as Frasers Centrepoint Trust and Ascendas. Yeah.
Yeah. Okay. I think we are coming to our time. There was a question. Will you be sharing the slides for us? Yeah, we'll share the slides in the community page, and also it will be in the PDF version. There was one slide missing. Actually, it wasn't missing. Just I skipped that. It was just the fourth reason for buying. Anyway. Okay. But anyway, Kimberly, you want to take over?